Hello, and welcome to the Mortgage Porter Weekly. I'm Rhonda Porter, mortgage advisor in the greater Seattle area. Thanks for joining me this week, April 6th, 2026. Last week was all about jobs, and the numbers were stronger than expected. The BLS jobs report came in with 178,000 jobs added in March, which was 3 times higher than what was expected. The unemployment rate ticked down slightly from 4.4% to 4.3%, and on the surface, this all sounds great. But if you look at other data, it looks a little mixed. So the private payroll data from ADP showed gains concentrated in just a few sectors, suggesting that the job market may not be as broad-based as the headline number implies. Continuing unemployment claims remained elevated, meaning it's taking longer for people to find new work once they lose a job. And layoff announcements are ticking higher with about 60,000 cuts reported in March. So again, the information here is kind of mixed, and we'll see what next month brings. Over the weekend, the president escalated threats against Iran, demanding that they fully reopen the Strait of Hormuz by Tuesday evening, which is tomorrow. Iran has responded with threats of retaliation, including against a $30 billion OpenAI data center in Saudi Arabia, following earlier strikes on Oracle and Amazon facilities. So how does this impact mortgage rates? The short answer is that it's really complicated, and it's pulling rates in two directions at once. Normally, when global uncertainty spikes, investors flee to the safety of U.S. Treasury bonds, and more demands for bonds pushes yields down, and mortgage rates tend to follow and improve. And we are seeing some of that, but at the same time, the conflict is driving oil prices sharply higher, which raises inflation concerns, and inflation is the enemy of low mortgage rates. So we're getting competing forces, and recession fear pushing rates down, inflation fear pushing them up. And that's a big reason why rates have been so volatile these past few weeks. According to the Acmo Blue Index, which tracks roughly 35% of mortgage transactions, the average 30-year fixed rate as of last Friday, April 4th, was 6.383%. And that's a slight improvement from what I reported the week prior. And of course, that's a bit encouraging. We like to see that. A few important reminders, though, is that you can't lock in last Friday's rates on today, and rates move daily and throughout the day. So they are also based off of your credit score, loan to value, your debt to income ratio, and there's a lot of other factors that influence how your rate is priced, including how many points you may pay or not pay for it. And that's not reflected in this graph either. So this is not a quote. This is just a directional gauge to show you which way rates are trending. And if you'd like a quote based off of your personal financial scenario that's current, please reach out to me. I'm happy to help you with that. There's a lot on the economic calendar this week, but frankly, the biggest rate mover is likely to be headlines out of Iran rather than any scheduled data release. But with that said, here's what we'll be watching this week. We'll be paying attention to the GDP being released on Thursday. That's the measure of economic growth. And PCE, which is personal consumption expenditures, is actually the Fed's preferred measure of inflation. So that carries a lot of weight as it will possibly impact if the Fed will make a move on the Fed funds rate later this month, which is not expected currently. So there is also a 30-year bond auction on Thursday. On Friday, CPI, or Consumer Price Index, is another key inflation reading that markets watch closely. And again, our next Fed rate decision is on April 29th. And right now, the odds of any change to the Fed funds rate are very slim. As of 7:30 this morning, here in Seattle, mortgage-backed securities, or MBS, are up about 12 basis points, and with stocks trading mixed. So what does this mean for you? This means mortgage rates are priced off of MBS. So when the MBS improves, or mortgage-backed securities, rates tend to improve too. And 12 basis points of improvement is modest but positive start for the week. And it may mean that lenders might be able to offer a slightly better pricing than what we had on Friday. So it's not dramatic, but it is a good sign heading into another volatile week. If you're shopping for a condo in Seattle, Bellevue, Kirkland, Tacoma, or anywhere actually in Washington State, there's something important that you need to know, and that's that rules have just changed. In March, Fannie Mae and Freddie Mac issued a major update to how condos qualify for conventional financing, and it's the most significant revision since the condo collapse in Florida back in 2021. And so here are some highlights, and we're going to go over the good news first, and that is that the 50% investor ownership limit has been eliminated. So a lot of urban and Seattle Bellevue high rises that were previously ineligible because too many units were rented out, or may now qualify. And if you've been told a building doesn't qualify, it may be worth asking your lender to take another look. So smaller buildings also get a break. Projects with 10 or fewer units can now skip the full project review process, making financing simpler. And now the changes that add a little bit of complexity, we have the limited review process used for about 40% of all conventional condo loans is being eliminated. Going forward, most projects will require a full review, which means more paperwork and more back and forth with the HOA and potentially longer closing timelines. So be aware of that. Plan for this when you're writing offers, and reserve requirements are also increasing. Starting in 2027, condos associations will need to set aside at least 15% of their annual budget for reserves, up from 10%. And on insurance, there's a new requirement for individual buyers. If the building's master policy carries a high per unit deductible, you'll need to carry your own HO6 condo insurance policy. Many buyers already do this, but it's now going to be a lender requirement in certain situations. I put together a detailed guide on all these changes over at my blog at mortgageporter.com. I'll have a link to it below here. That's your Mortgage Porter update for the week of April 6th. Thanks so much for watching. If you found this helpful, please share it with anyone that you know who might be thinking about buying or refinancing. And if you have questions about your specific situation or just trying to figure out your options regarding mortgages, I'd love to hear from you. Take care and have a great week. Bye-bye.